So welcome to this presentation. My name is Peter Youssef, Senior Market Analyst at IronFX. We are going to be mixing technicals with fundamentals today once again. Before we start on the fundamental side, I would like to make a small comment about the tensions and the escalation of the tensions and the attack practically of Iran on Israel, which may be for the time being a peripheral matter for the area of the Middle East. It's a big issue which tends to create substantial worries in the market. Now, we all know that Iran attacked Israel on Saturday to Sunday evening. The attack was practically, I would say, rather restrained in the sense that the Iranians had provided a heads up. I would say here that damage suffered by Israel was minimal, maybe. So that was a positive. But market worries are intense and currently seem to be focusing on whether the Israeli government will be responding to the counterattack of Iran. It should be noted that despite all doomsday scenarios, I tend to remain rather optimistic in the sense that we may have not seen the worst of it just yet, but we may see a rebound at a later stage. Overall, the situation is tense, it's fragile, and that tends to create substantial market turbulence. It's characteristic that we had yesterday American stock market indexes ending the day in the greens, and it was unanimous. You could see it as practically S&P 500, NASDAQ, and Dow Jones ended in the reds. Similarly, we saw also Asia closing red, and the Europeans are also in the reds. So there is a cautious sentiment growing up about what's going to be the next move from Israel and how the whole situation is going to be evolving over the next few days. I would be also noting here for Europeans, the developments in the war in Ukraine are not so encouraging either. It seems as if they are gaining the upper hand, or at least the initiative of the movement, and that does not seem to be changing unless the West actually provides with more and more modern weapons the Ukrainian side. So that's another source of worries for European traders mostly. So you have practically the whole situation revolving around the peripherals of the European Union. Now, let's have a look at the technicals though, and we make a start with EUR/USD. This is the forward chart. Allow me to drill into the daily chart. And we note here that we have a wider drop. Definitely these levels have now been breached from support, now are being broken and turned into resistance. Recalibration seems to be in order here. That's one. In green. Okay. Locking it in. At this point, I would be widening resistance and support line somewhat. Let's unlock the chart, go back hunting for a new support level. Green. That would be the 1.0320. We can see how that provided support back here. Readjusting the chart. Let's place some labels as well. And back to the forward chart. Let's make all labels visible. Done and done. Let's drill out to the daily chart once again. Here you go. Now starting with the S3, which is now being placed at 1.0320. The S2 at 1.0445. The S1 at 1.0560. The R1 at 1.0655. The R2 at 1.0755. Sorry. And the last resistance line at 1.0. Give me a sec, sorry. At 1.0885. Locking everything in. Now we tend to see an intense downward motion of Euro USD over the past week. However, we see that there is some support during today's European session. Nothing much though. I would be treating this more like a correction rather than a change of trend. That's obvious. Also note that the RSI indicator has reached below the reading of 30, implying a strong bearish sentiment on behalf of the market for the pair, yet at the same time maybe implying that a correction higher is quite possible for the pair. Similar signals are stemming out from the fact that the price action has breached the lower Bollinger Band, which could be slowing down the bear somewhat. But overall, the bearish outlook seems to remain. And in my opinion, we may see the price action regaining its downward momentum and starting to aim for the S1 1.0560. If breached, we set the next possible target for the bears at 1.0445. For a bullish outlook, I would require the price action to breach, the R1 1.0655 and reach as high as the 1.0755. Once again, for the time being, we tend to maintain our bearish outlook. Moving now to USDJPY. This is the 1 hour chart. Moving to the daily chart. Readjusting. Okay, definitely we need to make some readjustments here. And it's characteristic how the price action is currently testing the give me a sec. The 154.50 resistance line right now. And definitely we need to recalibrate it, given that we had a wide rise of the pair yesterday, showing us that volatility is on the rise. Now we have set some indicator levels. However, I would be scrolling back to the daily chart back in 1990 to see what the market reaction was back then. However, it's highly improbable that we will find the same forces resisting or supporting the pair at the time. Let's move back. Weekly. There you go. Daily. So what do we have here? We have the price action, which is now testing the first resistance line. I would be setting the next resistance line even higher. You can see how this level provided support. The next one at the peak. You can see the sideways motion here. Once again, though, it's highly doubtful whether these levels will be adhered to. So we make a start with the R3 being set at 160.20. The R2 to be set at 156.60. And the R1 at 154.5. A level which is being tested right now. The S1 at 152.80 could go 75. Could go even lower. $150.70. You can see how that level provides support back here. I'm going also to be lowering the S3. $150.80 being the S2 remains. 148.85. And I'm also noting the 146 as the ultimate support line. Locking everything in. In my opinion, here we have conflicting fundamental forces in play, or at least could come into play. On the one hand, we may see safe haven inflows supporting the Japanese yen, in which case we may see USD JPY falling. Another factor which could support the Japanese currency could be a possible market intervention by the Japanese government. Please note that the price action has breached above the 152.70 resistance line, now turned to support, It's currently testing the 154.50. In my opinion, we are already within a zone at which the Japanese government could intervene given the weakness of its currency. So that's an issue. On the flip side, we can see how the US dollar continues to strengthen against its counterparts, and that's pushing USD JPY to its boundaries. For the time being, we tend to maintain a bullish outlook, and we're basing this practically as we shift the upward trend line to the right, setting new limitations for the upward movement. Also note how the RSI indicator remains clearly above the reading of 70, implying a rather strong bullish sentiment on behalf of the market for the pair, but at the same time maybe also implying that the pair has reached overbought levels and may be ripe for a correction lower. We get once again similar readings by the fact that the price action has breached the upper Bollinger Band. Mind you that all three major moving averages, in this case you can see it in the blue line here, the 20 moving average, the green line here, which is the 100 moving average, and the orange line, which is the 200 moving average, all three are pointing upwards, supporting the idea of a bullish outlook for the pair, or at least for continuance of the bullish outlook. Once again, we tend to maintain a bullish outlook for USD JPY. However, I would like also to issue a warning for a possible correction lower of the pair. As long though as it remains above the upward trend line, we tend to remain bullish. For a bearish outlook, I would require the pair to drop, breach the prementioned upward trend line. I would require also a clear breach of the S152.70 and the price action to start aiming, if not reaching, the S250.80. That would allow us practically to draw a downward trend line showing us the limitations of the downward motion. Okay, let's have a look at USD CAD. USD CAD, which tends to get out of the chart here. And definitely we have to correct this into a support line, as well as this. Let's go hunting for new resistance levels. But before we do that, I'm going to be recalibrating a little bit the resistance supports below it, starting with the S2, which is now being placed at 1.3725. The S3 could be lowered a little bit, right here, at 1.3660. Now let's go back and see where we can find resistance lines. Definitely we have one here. Albeit it's quite narrow, but it's a very clear peak which we cannot neglect. And it's at the 1.39, a bit high, 38.95. Good enough in red. Let's go looking for another one. There's a very clear peak here which cannot be neglected. Setting it as the ultimate resistance line at 1.3975. Lock in. Readjust the chart. Let's set also the labels. Always remember we are in the 4-hour chart right now. Let's drill into the daily chart. That's better. That tends to make more sense now. Okay, let's correct also the contents of the labels. Starting with the R3, which is now being placed at 1.3975. The R2 at 1.3895. The R1 at 1.3840. The S1 at 1.3775. The S2 at 1.3725. The S3 at 1.3660. Clear upward movement, very intense. Most probably we will be seeing a correction lower. It's bound to happen at some point. But the bullish outlook is there. And even with the correction lower, I would still maintain a bullish outlook. Note how the price action has surpassed the upper Bollinger Band, highlighting the strong bullish sentiment of the market for the pair. At the same time, I would be noting that the RSI indicator is also above the reading of 70, both implying a strong bullish sentiment, but at the same time, both are implying that the pair is at overbought levels and is ripe for a correction lower. I would be highlighting, though, a secondary upward trend line, which has intensified its slope, but that's too steep. It tends to be almost vertical. So a correction breaking the secondary upward trend line would be possible. Actually, it's expected. However, the first one tends to show us the true course, in my opinion. And I wouldn't be surprised to see the price action dropping, breaking the S1 1.3775, yet remaining above the upward trend line, maintaining thus the upward momentum. For a reversal, or at least a change of the outlook, which is currently bullish, I would require a clear break of this upward trend line, practically showing us that the upward movement has been interrupted. And should the price action also breach below the S2, 1.3725, that could be a beginning of a bearish outlook. Once again, we will have to wait and see here. Now, on the fundamental side, for the Canadian dollar, I would be noting practically two factors. The first would be the market sentiment. The market sentiment affects the Canadian dollar widely in the sense that it practically is considered, the Canadian dollar is considered a riskier asset given to its commodity currency nature. Now, should the market sentiment continue to be cautious or even intensify its cautiousness, we may see the Canadian dollar suffering and allowing for USD CAD to rise even further. The second fundamental element I would be highlighting here would be the path of oil prices, given Canada's status as a major oil producing economy. So the market sees a positive correlation between oil prices and the Canadian dollar. Hence, should oil prices start rising, we may see the Canadian dollar gaining some ground and vice versa. Also, bear in mind that we have the release of Canada's CPI rates for March today. Should the inflation rates actually accelerate, that could harden the stance of BOC somewhat, and in my opinion, that could provide some support for the Canadian dollar. On the flip side, should the CPI rates slow down, especially the core and practically the core and headline CPI rates on a year-on-year level, then we may see the Canadian dollar losing some ground. Okay, let's also have a look at a sec. Let's have a look at GBP USD. Zoom out, daily chart, readjust the chart, an intense downward motion, and definitely I'm going to be widening the resistance support lines here. Here you go. So what we have done is to recalibrate and widen the resistance support lines. Practically, we are setting the first support line on this peak here. It also form a resistance line. It was clear how it has reversed the upward motion of the pair. However, given that the price action is above it, now it forms a support line. And we're talking about the 1.2335. Moving now to the second support line. We're basing it practically on this level here, this row, where you had an intense downward motion, which was reversed. It was a beautiful V-shaped price action here. And that would be the 1.2180. And finally, we note the S3, which is being based on the lowest point of our chart. That would be the 1.20.35. Sorry, 1.2035 in green. Let's have a look at the resistance lines. The R1 being set at the 1.2470. The R2 being set at the 1.2590. The R3 being set at 1.27, let's have a look, 0.10. Locking it in, downward motion, I think it's clear. You have consecutive lower peaks and lower lows, 1, 2, 3, 1, 2, 3. So we have a downward motion, which may be even more intense, or at least may have intensified over the past week. I would expect the downward motion to be maintained. Note that the RSI indicator remains near, but just above the reading of 30, which on the one hand implies that there is a strong bearish sentiment on the market for the pair, for cable. On the other hand, though, I would expect it to be maintained despite some hesitation here. You can see that there was a hesitation yesterday and during today's European session. Technically speaking, that may have been caused also by the fact that the price action on Friday was able to breach below the low Bollinger Band, which practically forced the bears to hold their descent or the descent of the pair. So I would expect the sideways motion here, or at least the stabilization, to be temporary, but still there. Overall, the bearish outlook, even should the price action correct higher, breaching the R1 1.2470, as long as it remains below the downward trend line, let me correct it a little bit here, then we tend to maintain a bearish outlook. Now, I can see that in the comments, you're asking me to compare the resistance support lines we have drawn with Fibonacci. To tell you the truth, I'm not a big fan of Fibonacci, but let's do it. Let me color them in blue. Fibo levels also to be colored in blue. And that's more visible. We have started from the peak edge to the lowest point. So we definitely have a match here. We have another level, which is the 23.6%, comes pretty close to our S1, 1.2335. Also, the 38.2% is coming pretty close to the R1, 1.2470. We have a perfect match at the 50% with our 1.2590. Similarly, also the 61.8 cuts it pretty close with the R3, 1.2710. Now, the peak here is totally neglected, and the Fibonacci levels go all the way up to the 100%. In my opinion, they're pretty close. Once again, we have a deviation, a slight deviation here, while the S2 is totally neglected by the Fibonacci's, as is the R4. To tell you the truth, I understand the validity and the usefulness of Fibonacci's. However, in my opinion, I prefer to base the resistance support lines mostly on actual peaks and shows. So the number sequencing, in my opinion, is not enough. Okay, allow me now to delete it. There you go. Let's move on to the Aussie. Okay, so we have the R1, the R2, the R3. The first support line could be a little bit wider, and I would be placing it actually here. At the 0.6480. $64.30. Let's go hunting here. Definitely these levels. This could go a little bit higher. Actually, you see this peak here. It's a beautiful peak which could not be neglected despite the breaking here. 0.6490, 10 pips higher in red. Now, on a fundamental level, I would be noting the release of China's GDP data. They were released during today's Asian session. And at this point, I would be noting that the GDP rate accelerated, improved, not accelerated, did not slow down as much as expected. That was among the positives. I'm still maintaining some worries though, and as a potential flow point, I would be noting the release of the industrial output growth rate, which slowed down considerably, and the retail sales growth rate. And the slowing of the retail sales growth rate highlighted, in my opinion, a weak point of the Chinese economy, and that would be the internal demand side of the Chinese economy. Now, given the sensitivity of China's economy as a primarily export-oriented economy, and given that sanctions have been placed already and may intensify in the future, that may more or less imply that the Chinese economy may have to rely in the future on internal demand in a wider degree than before. On the other hand, we have to also note that the slowing of the retail sales growth rate for March may have been understandable given that we had the new lunar year in February, at which the Chinese consumers may have increased their spending and tried to hold on a little bit during March, hold back a little bit during March. So that could have been more or less expected. Once again, though, aside of an explanation, in my opinion, that's still a weak point. I would like to see the Chinese internal economy, or at least the internal demand side of the economy, getting some more support here. Let's go back, find some more levels. Now, for the S2, I'm noting this level, and I'm noting it because we have multiple touches here. Could go a little bit lower, just about here. 1, 2, 3, aimed for here. Briefly broken here, so that's also understandable. And that would be in green. The 0.6285. Now, as I'm correcting the levels and placing support and resistance lines, also allow me to discuss a little bit what's coming up for the Aussie. We expect Australia's employment data to be released tomorrow during the Asian session, or the day after tomorrow. Give me a sec just to verify that. And overall, the unemployment rate is expected to rise from 3.7 to 3.9%. At the same time, the employment change figure is expected to drop considerably from the still 100,000 plus, and that may more or less, the employment data of Australia are due out on Thursday's Asian session. Overall, the forecasts tend to imply an easing of the Australian employment market, which could be more or less weighing also on RBA's stance and add pressure for rate cuts to come in by the bank. So overall, should the actual rates and figures actually imply an easing of the tightness of the Australian employment market, then we may be talking about a possible weakening of AUD. Let's widen a little bit the chart here. We have a nice clear downward motion. Starting with the S3 at 0.6195. Setting also the S2 at 0.6285. Let's have a look at the S1, which is our next support line. $0.6365. VR1 at 0.6410. Actually 30, sorry. So it's 0.6430. First resistance line. VR2 at 0.6545. And VR3 at 0.6635. Now I have widened the resistance, the distance between the resistance and the support lines. I know that there has been some slow moving over the past 3 days regarding AUD USD. I would be worried though that we may see volatility starting to intensify. And clearly we tend to maintain a bearish outlook given that we have the downward trend line which continues to guide the pair lower. The RSI indicator on the daily chart remains below the reading of 30, once again implying a bearish sentiment on the market for the pair, which could actually guide it lower. Yet at the same time, once again, we note how the fact that the RSI indicator is below the reading of 30 implies that the price action remains at oversold levels and may be ripe for correction higher. Once again, though, at this point, the price action has bounced on the lower Bollinger Band and there is some distance created, so that could allow for the bears to take over and lead AUD USD towards the 0.6365. For a bullish outlook, I would require the pair to rise, breach the 0.6430 resistance line, breach the pre-mentioned downward trend line, which in my opinion would be signaling the interruption of the downward motion. However, I would require the pair to start aiming for the 0.6545, if not actually reach it, before adopting a bullish outlook for the pair. So that should sum it up for the day. From all of us here at IronFX, best wishes for solid trading.
Okay, let's go ahead and get started. So this week's webinar will be on multi-time frame trading strategies. And before we get started, just a risk warning as per usual. Our products are traded on margin and carry a high level of risk. And it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. A disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of the material is strictly prohibited. Okay, so I'm Melanie Chong, and I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. So we're gonna look at which time frame is the most important, how you can take a top-down approach, what you should look out for on the higher time frames, zooming into lower time frames, and then we'll look at how you can craft your strategy. Okay. Okay, let's get started. So firstly, before we get into everything, we're just going to do a really quick recap on the basics of trading. Okay, so firstly, we'll look at support and resistance. So it's basically the price at which an asset's price tends to stop falling, which would be your support, or stop rising, which would be your resistance. So to identify these levels, you can use technical analysis tools such as trend lines, moving averages, chart patterns, or you can also look at previous highs and lows of the asset, as well as volume data to identify potential levels of support and resistance. So we're gonna briefly look at this today, and then we'll get into I'll show you guys in a little bit why we're going through this before we get into the multiple time frames. Yeah, so it'll make more sense in the next slides. Okay, so I've added an image here for you to see how we can use swing highs and lows as resistance and support levels. So you want to take note of how there are clear peaks and troughs in the market structure, in order for them to be used as support and resistance levels. So let's first take a look at an incorrect example. So here's an example of insignificant swings, which are bad points to use for any kind of levels. So be it your support and resistance levels or starting points for your Fibonacci. Price movements over here are way too small, and there are no significant swing highs or swing lows. Okay, so here's another incorrect example. So there aren't really any clear swing highs or lows, and price movement is relatively small. Okay, so now here's a correct example of significant swings. So there's a really clear move up and down with obvious peaks and troughs and clear market movements. Here's another example. So I've drawn out the peaks and troughs to point out exactly how clear your charts should look like. Okay, so you can take these support and resistance levels as profit targets or stop loss levels, but you should not use it as an entry if there are no other supporting arguments such as Fibonacci or other graphical levels to support your analysis. Okay, because using a recent swing high or low is a weak level if that is the only level. Okay, so if there are at least two swing highs or low levels lining up nicely, then it's a much better level to use. So you want to try to find areas where these might line up. So it doesn't have to be exactly at the same level. So long as it's about a similar area, that's good enough. Okay, so one way to try and find these multiple swings is to try and see how far you can pull back your resistance or support levels. Okay, so as you can see in the GIF, it's okay to cut through these tiny wicks, but you typically would want to avoid cutting through the bodies of candlesticks. Okay, so now let's look at what other things to look out for when inputting a support or resistance level. Okay, so picking the starting point, you want to look for, or rather a pivot entry. you want to look for support or resistance levels, and there are a couple of rules. So firstly, you want to check if there's a swing high or low, pullback or overlap level to start from. Okay, so I mentioned earlier that we want to try and pull back the level as far as we can. Intersecting the wicks is preferred. You can refer to this image here. So you can see this green thumb is obviously that it's recommended, which means basically because it cuts through only the wicks of the candlesticks. These are okay because even though it does cut through only the wicks, it's not that preferred because there isn't a very clear swing high or swing low over here. Okay, so preferably we want to look for intersections that we will see in the coming slides. So for example, here we have a red thumb here. And the reason for that is because it cuts through way too many bodies of the candlesticks. So you can see the green thumbs here cuts through just the wick of the candlestick, which is preferred. Okay, so just basically I want to look for a nice clean cut and not something that's messy like this one here. Okay, so another example here. Take note of this red highlighted area because you want to avoid intersecting so many candlesticks. Even though you might be able to argue that over here it's just the bodies, or rather it's just the wicks of the candlesticks, but it's way too messy over here. Okay. Okay. Next. So here's what a clear market structure looks like. Fibonacci retracements can be used in both choppy and trending markets, but it is important to look for a really clear market structure even before you get started on your actual analysis. Okay, so like for example here, this is an example of an unclear market structure. So you can see it's very messy, it's really difficult to conduct your analysis on. So this is typically something that you want to avoid. Okay. So which time frame is the most important? So one important thing that we can do to our analysis to adjust the time frames so that the market structure is clearer. So here we have an example of an unclear market structure. Okay, so this is on the 15-minute time frame, and you can see it's really messy. There's no clear movements in price. But if you change the time frame that we're looking at to 1 hour, this is what we have, and you can see the highlighted portion has much clearer movement. So it's way easier to conduct your analysis on the H1 instead of the M15. And both of these is on the same asset that we are analyzing. Okay, so there's two criterion that you should look out for. Firstly, a clear swing low or swing high. And secondly, a really clear trend as well between the starting and the ending point. Then your Fibonacci retracement or your analysis is more likely to be accurate. Okay, okay, so now let's look into a brief intro into our multi-time frame analysis. So now we've gone through what you should look out for and how you can kind of adjust your time frames so that your charts appear clearer. So let's look at what other things you can use with your multi-time frame analysis. So it basically involves analyzing the market from multiple time frames, and it can help a beginner trader get a better understanding of the market and make more informed trading decisions. So the first step in this strategy is to select the time frame. Typically, traders will tend to choose at least two time frames. So that would probably be a shorter time frame and a longer time frame. The shorter time frame is used to identify the most recent trends and price movements, while the longer time frame is used to identify the overall trend and market direction. So once the timeframes are selected, the trader will then analyze the market from each time frame, looking for key support and resistance levels, trends, and patterns like we've done earlier. So for example, if the short-term trend is bullish and the longer term trend is also bullish, then it could indicate a strong uptrend in the market. So obviously, if you're a trader, this would be really helpful to make your trading decisions. So for example, um, if the short-term trend is bullish, then you might look into buying on dips or pullbacks in the market. Conversely, if the longer-term trend is bearish, then you might look to sell or short the market. Okay, so it basically helps you to kind of zoom out and look at the bigger picture, analyzing trends and patterns from multiple time frames. Okay, so what should you look out for on the higher time frames? Firstly, we have the key graphical levels. So basically the horizontal levels that we looked at previously, how to identify your support and resistance levels, which is why we went through them before we started this. And then, of course, being able to identify your trends using trend lines and trend channels. Thirdly would be breakouts. So breakouts of these trend lines or trend channels or any of the support and resistance levels. Big moving averages, 50, 100, 200, golden cross or death cross. Ichimoku cloud also helps you to identify changes in trend or continuations in trend as well. And big Fibonacci levels that we mentioned earlier, such as your retracements, your extensions, projections, so on and so forth. And lastly would be price action. So price action basically is the past, present, and future. And you're trying to look at your momentum from the previous bar to dictate your strategy. Okay, so these are the different types of trading on the higher time frames. So for trend trading, it involves identifying and trading with the prevailing market trends. So traders would tend to enter positions in the direction of the dominant trend and hold them until the trend shows signs of reversal. This strategy often involves the use of technical analysis tools to identify and confirm trends. Next is swing trading. So swing trading refers to capturing shorter term price swings within a larger trend. Traders tend to enter positions at swing highs or lows and take profits as the price moves in their favor. So for swing trading, this strategy typically will involve holding your position for several days to several weeks, because you are trying to take advantage of the price oscillations. Okay, and then thirdly, breakout trading. So this involves entering positions when the price breaks through key support and resistance levels. So as a trader, you would tend to look for strong momentum and volatility following a breakout and aim to profit from continued price movement in the breakout direction. So this for breakout trading, it involves a little bit more careful analysis and of price patterns and the volumes to confirm your breakouts. Okay, lastly, we have mean reversion trading. So this is based on the idea that prices tend to revert to their average or equilibrium levels after deviating from them. So traders would identify overbought or oversold conditions and take positions with the expectations that prices will eventually revert. So this would typically involve you using a couple of technical indicators, so like your RSI, your stochastics, in order to identify these potential reversals. Okay, so if we look at the lower time frames, there are also different kinds of trading methods. So firstly, we have scalping. So this is a high frequency trading strategy where traders aim to make quick profits from small price changes. So they open and close multiple positions within a short period. And sometimes it could even be as little as seconds or minutes, um, as long as they catch small price differentials. So scalpers often rely on technical analysis indicators such as your moving averages or oscillators to identify short-term trading opportunities. For day trading, it involves opening and closing positions within the same day without holding positions overnight. So day traders would focus on intraday price movements, and they typically make multiple trades during the day. So they aim to take advantage of more short-term trends or volatility using technical analysis tools, chart patterns, real-time market data for trading decision making. Third, we have momentum trading. So this focuses more on capturing strong price movements that's driven by increased buying or selling pressure. So in order to do this, traders normally will look for stocks or assets that exhibit significant price momentum and then enter positions in the direction of the prevailing trend. So the kinds of tools or indicators that you would use would be something like your RSI or moving average convergence divergence or MACD to identify momentum opportunities. And lastly, we have news trading. So news trading involves taking advantage of significant market moves that result from news events or economic data releases. So traders will closely monitor the news, announcements, and enter positions based on the impact of the news on the market. So they aim to capitalize on the price volatility and rapid market reactions that occur immediately following news releases. Okay, so now that we know the different kinds of long-term and short-term trading, and we also know how to identify significant swings and use them as support and resistance levels, let's take a look at how you can craft your strategy, depending on, your lifestyle and what are the different kinds of time frames that you might choose. So starting off with scalping, this is obviously for a shorter time frame. So this kind of trading is fast-paced, it's exciting and mind-rattling. And there's obviously short time periods between the opening and closing of a trade, but you grab very small amounts of pips. You're also risking a very small amount of pips as well. So it does depend on your own um, your risk tolerance. But it allows you to take advantage of market volatility and you're able to avoid known unknowns. So your locus of control, because you're looking at 20 pips versus a 200 pips. And there are new opportunities every time you open the chart. Okay, so the holding time tends to be from a few seconds to a few hours. If you are trading, what we typically recommend will be 1 hour in the morning, 1 hour in the afternoon, and 1 hour in the evening. But it is important to have proper risk management so that you don't need to monitor the trades all the way. Okay. Now let's look at the three powerful scalping strategies. Firstly, we have the horizontal pullback strategy. Then we have the Fibonacci retracement strategy. And lastly, the Nike tick strategy. So firstly, horizontal pullback. Basically, this is what we call pullback. So when price, so you can see firstly there is this resistance. It's a swing high resistance with 3 swing highs. So you can see that price has broken out of this resistance level it surpassed it, but we're expecting it to pull back or retrace back to this level. That's why we call it a horizontal pullback strategy. So this is what we call a pullback support because we are expecting price to bounce off of this level. A pullback resistance is something like this. So you start off with a swing low support level, and then price breaks out of that support level, and we're expecting it to retrace back to that level. Okay, so if we're looking at an example on the charts, here we have an example with Ichimoku. So the Ichimoku cloud, how you typically would use it is if price is moving below the cloud, then it's an indicator that price is in a bearish momentum. But if price is moving above the cloud, then it is in a bullish momentum. So in this case, we have this swing low here, and price bounced off of it. It has broken out of it, surpassed it, and now we're expecting it to come back to that level. Okay, and you can see that's exactly what happened here. Okay, so now if we're looking at a Fibonacci retracement strategy, you should remember that your Fibonacci trend line must follow price structure clearly. Even though the trend line can deviate from price structure, it shouldn't deviate too much. So in the example that you see here in this GIF, you can see that the line that's been drawn, this orange line, it is basically the shape of price structure, but our Fibonacci trend line cuts through the entire shape. So this is something that we want to avoid. Okay, so if you're new to Fibonacci, and I have a couple of questions on that in the chat, I'll just show you guys this website that you can use. I think we've previously gone through the Fibonacci series on these webinars, but if you've missed that, not to worry, you can go ahead and look it up on theforexarmy.com. Okay, so yeah, that's theforexarmy.com, and then you can take a look at this trading guide, which is pretty comprehensive. It gives you a bunch of examples, some videos as well that you can watch. Yeah, so it's everything that we went through today, and it gives you a more in-depth understanding of how to use the different Fibonacci techniques. So like your retracements, how to draw them, what to look out for, how to find confluence areas as well. Yeah, so you can go ahead and take a look at that. If there's time at the end of my slides, I might briefly go through some of these techniques. Okay, but if not, yeah, you can just take a look at this website. Okay, let's get back to my slides. So the tool that we're using here is the Fibonacci retracement tool. And there are a couple of levels that we're looking out for. So here you can see we're looking out for the mid-range. So 23.6, 38.2, 50%, 61.8, and 78.6. Okay, but even though the tool is the Fibonacci retracement tool, it leads us to 3 different types of Fibonacci expansions. Okay. So firstly, we have a Fibonacci retracement plus pullback. So this is the pullback that we just talked about. You have 2 swing lows here. Price has broken out of it, and we're expecting it to pull back to this level here. Okay, we also have this retracement. So take note of how closely this trend line follows the shape of the price structure. And over here, you can see our 61.8 lines up nicely with that pullback level. Okay, I also have another Fibonacci level. This is also a Fibonacci retracement. So it's from the upper swing high all the way to the lower swing high here, or swing low. Okay, so in this case, the 50% lines up nicely with that level. So we have two Fibonacci levels lining up with a pullback resistance. So we're expecting it to reverse off of this area here, which you can see is exactly what happened. Okay, if you're wondering why we chose this level as our I guess as our support, is because it's an overlap level, which basically means there is a swing high here and a couple of swing lows that line up in the same level. Okay, so that's why we are expecting price to be attracted to such areas. Okay, let me know in the chat if you guys have any questions as well. Next, let's look at this example, which is another Fibonacci retracement plus pullback, but this time we are also adding in a Ichimoku cloud. Okay, so here we have a descending trend line, but it's not exactly a valid trend line because it doesn't have we need at least 3 touches on the trend line to be considered valid. You can see over here we don't have that. Okay, so we're expecting price to bounce off of that level, off of the trend line again. We also have this Fibonacci retracement from the swing high to the swing low, and our 38.2 lines up at the area where we're expecting price to bounce off of. Okay, in this case, we are also using 2 indicators. Yeah, okay, let's look at this one first. The first indicator we're using is an Ichimoku. So you can see price is just about moving above the Ichimoku cloud, which is a bullish signal. Now, if we look at this slide, you can see our stochastic is giving us this hidden resistance level, which basically means that we're expecting price to also respect that area, like it did here. So you see we have one resistance level lining up with another over here. Even though price is making a lower high on our stochastic, it's remaining at this resistance level. So this is the second time that it's happened, and we're expecting it to happen again another time here, which you can see that's exactly what happened. Okay. Okay, so let's move on to our last strategy. So this is what we call a Nike tick strategy. So just to recap again, we have so many levels for 1, 2. Again, the two we're using here is the Fibonacci retracement. So the Fibonacci retracement, we have the levels that are above 100, the mid-range levels, and the negatives. So the negatives we call Fibonacci expansions. But now for Nike tick strategy, we're going to look at the extensions. So for extensions are the levels that we use that are more than 100%. So that would be 127.2 and also 161.8. So here's an example. You can see the yellow arrows show us the shape of the Nike tick. So our starting point is over here, basically the head of the arrow or the shorter part of the tick. So you should make sure that price fully breaks out of this 100% before you go in and use this strategy. So our 161.8 is the projected level at which we are expecting price to reverse off of. Okay, you can see that's what happened here. That's basically what we are looking for. Any reversals off of either the 127.2 or like we see here, 161.8. Okay, so here is a GIF of what we are looking for and how it works. So we firstly want to see if it's going to break out of the 127.2 level. And if it doesn't, then we go in and expect there to be a reversal at the 161.8 instead. Okay. Okay. Let's move on. So for the Nike tick strategy, we typically would recommend these timeframes. So the M30, H1, H4. Entry criteria would be if price breaks out of the 127.2. Okay, so we're using a stop loss at 145%, idea invalidation at 138%, break even would be 11% of the recent move, 50% take profit will be 11% of the recent move, and a full take profit is if there is 22% of the recent move. Okay, so you can see the levels that we are using here. The bonus we are also using all of these levels. So let me get into them now. So firstly, let's focus on the Nike tick. I think you guys can kind of get the idea now. You can see the shape of the tick. So we're looking at the 127.2%, which price has reversed off of. For the Fibonacci projection, we are looking at this level here. This shape rather, this flash kind of shape. And it's also 3 points. 3 points would be the starting point, middle point, and ending point. And you can see that we have a 100% lining up at that level. Okay, so the 100% lines up nicely with our 127.2. Okay, and that is our kind of our Fibonacci confluence area. So since we have two levels lining up, we call that a confluence area because it's more validation that price is likely to reverse off of that area. Next, Fibonacci expansion. Okay, no, we don't have that here. But why we mention support and resistance is because at this swing high, if you draw a horizontal line across, we're actually expecting price to bounce off and hit back to that level, which is why we have highlighted this arrow to hit back towards this area. Okay, so here's a long example instead. Again, you can see the shape of the Nike tick. In this case, it's an upside down tick, or rather an inverted Nike tick. So the head is from here, starting point here, ending point here, and the tail is here. So we're expecting price to bounce off here, and it did. So it bounced off this confluence area. Again, the confluence area is the 127.2 Fibonacci extension or Nike tick. And then we also have this 61.8% Fibonacci projection. So for the projection, just to recap again, the starting point here, middle point here, and ending point here. Okay, so it lines up and we can see price shot up after that. Okay, so another thing to maybe take note of is this minus is what we call our Fibonacci expansions. So for Fibonacci expansions, we're looking at these two numbers, the minus 27.2 and the minus 61.8. So you can use these levels as well to determine where we expect price to bounce off of next. After this reversal, you can see that there is this flash shape or lightning bolt shape. So it's very similar to your projection, which also uses a lightning bolt shape. So you can use these two Fibonacci techniques together, and you can see once price reversed here, we expect it to reverse off of the minus 61.8, which you can see it did. Okay. Okay, let me know if you guys have any questions. Okay, if not, I think we still have time to do a bit of live analysis. So you can let me know in the chat if there are any, if there are any specific charts that you'd like me to go through. I think we might have time to just go through one. Okay, let's go through gold. Okay, can you guys see my charts? Okay, so on our weekly time frame, so like I mentioned earlier, we want to start off with our higher time frames and then work our way down to the lower time frames so that we get an idea of where prices are headed towards. So on our higher time frame, we can see this ascending, can definitely see price moving in this in an uptrend. Okay, so we're gonna see if we can find any ascending trend lines or trend channels to support that. Okay, I think I kind of can see, can see this ascending trend channel. Okay, so what makes a valid trend channel is if there are at least two touches on top and two touches below. So let's look at our daily time frame now. Okay, and let's go in with some levels. Okay, so to start off, I think I have a Nike tick shape here. Okay. I'm gonna try and zoom in so that you guys can see. So the shape, the Nike tick shape is like this. Okay. And I can see that price is approaching my 161.8 level. So I'm gonna place a resistance level over there. This is my first resistance. My first support, I'm just gonna place it here at that swing high. Okay, so this is what we have on our daily time frame. So let's look at our 4-hour time frame now. Okay, on our 4-hour time frame, you can see we have this swing high lining up nicely, and this is a resistance. Okay, I'm not sure if we have any Nike tick levels here since it's so small. Okay, no. If we take this Nike tick shape here as well, you can see the shape like this. Okay. Can see the 161.8 lines up with our first resistance as well. Okay, and I'm just going to place our first support at this 127.2 level. Okay, next I'm going to be looking for some retracements. Also, this is my first support. And at this level, it's in line with this 38.2. Okay, so this is my second support level. Then I'll see if I can pull it back some more. Okay, so overall, we have a pretty bullish uptrend from our weekly as well as our daily time frames. So we're expecting prices to continue to move upwards. So let's take a look at some indicators to support that. So I like to use Ichimoku and MACD first because at one glance you can see exactly what the signals are. So price is moving above Ichimoku cloud, so it's giving us a bullish signal. MACD is also giving us a bullish signal. If we look at Bollinger Bands, you can see it is also giving us a bullish signal. RSI. Actually, Bollinger Bands is not giving us a bullish signal. If I zoom in, it's not peaking above the upper band. So I'm gonna remove this. If we look at our RSI, it is moving in the overbought area, which might be a signal that it's going to drop. So let's take a look at some other indicators. Let's look at stochastic. Okay, stochastic is moving in an ascending trend line, which could suggest that it's going to move higher as well. Okay, let's look at one more indicator. Okay, so MA cross recently occurred, okay, which suggests a change in trend. So over here, you see that price is kind of ranging in this area. Recently it crossed, which could suggest that it's going to move higher. Plus, prices are moving above both of the MAs, both of the moving averages. So it is still giving us a bullish signal. Okay, so I'm going to move my RSI because it doesn't support our analysis. Okay, so we're expecting it to continue to move higher towards our 161.8 and this swing high level here. Okay. Are there any questions? Okay, no worries. Okay, if there are no other questions or other requests, then I think that's all for today. Thank you so much for joining me, and I'll see you guys again next week. Thanks, everyone. What do you mean with toy? So basically, you click on this symbol, and let's say we are analyzing Euro USD, for example, right? And then, so depending on which broker you're looking at, click on it. And I like to start off with a clean chart. So it will look like this. Um, if that's what you mean. Time frames are over here. Indicators here. If you're talking about Ichimoku, or rather Fibonacci, the Fibonacci is this one. This is the retracement. So like this. This is the projection I was talking about earlier, which has 3 points like this. Um, oh, so for your support and resistance levels, I just basically use this tab here, this moving tab, which has these horizontal rays. And when you click on it, it's actually blank, but they do give you the option over here on this icon to choose whether, what you want to label it as. For indicators, we have starred these, but you can look up. There are so many indicators out there, so depending on what you are comfortable with, for example, maybe pivot points, we didn't star. So if I'm looking at pivot points, I might star this as well, and then it will show up in my favorites here. But you can just search it here in the search bar. Sample resistance 1, we have them preset. Okay, for example, this. Do you mean the template? Mm, oh, for indicators, you set favorites, for example, pivot points with this star here. Yeah, add to favorites, and then it'll show up in this column here. For this template, I'm actually not too sure. Oh, like this. Save drawing template as, and then you type resistance 1, resistance 2, save, and then I think it will show up here. Okay. You have any other questions? Okay, we'll see if we can do a full session on how to use TradingView. But yeah, thank you so much for joining me. Thank you for the questions. Have a great rest of your week, and I'll see you again next week. Thanks. Bye.